Hello, this recording is about Chapter 9, dealing with long-term assets, or assets that are going to be around for quite a while, many years. And because they're around for a number of years, there's actually going to be more accounting issues that we're going to study. You know, when we buy it, when we actually use it, and then we finally, years later, actually get rid of the asset. So let's look at what kind of things are we talking about here. Well, things like equipment, buildings, automobiles, those sort of things. Those are assets that are going to exist for more than a year, making them long-term. Well, let's start with the first accounting issue. When we buy it, what is the cost? And hopefully you remember, we actually dealt with the cost principle when we studied merchandise inventory. We had to figure out, well, what is the cost of the inventory? And we said, well, usually it's the cost of not only buying the goods, but usually sales tax, and if we have to pay shipping, the cost of getting the goods to our place. Well, we're going to find it, looking at these long-term assets, the cost of them, when we initially buy them, it's going to have the same sort of principle. It's going to be all costs that are reasonable, to not only buy, but get ready. So get it ready for its intended purpose. So let's go look at an illustration of what that might entail. So here's a little problem that you're going to be doing. And so the company spent a total of $30,020, but how much is really just pertains to the delivery truck? You know, in other words, you know, here we have our asset, and let's just say truck is the asset, right? It goes up with debits, and assets go up with debits and down with credits. What are we going to debit it for the cost? So we certainly, the purchase price, right, is going to increase the cost of the truck. And then installation of shelving. Well, that fits this definition of getting it ready, right? Because we tend to drive the truck to deliver goods, and so we need that special shelving. Painting and lettering, yes, that would be a cost of acquiring it. And you can see I've already said no and no here. The motor vehicle license, the annual insurance policy, those are really annual expenses, right? They're not a cost of getting it ready. They're an annual cost that we have to pay to have insurance and have a license to drive the truck. Sales tax, yes, that's a kind of a one-time thing, right? When we buy the truck, it's a cost of buying it. So if I add up those four things, I'm going to get $27,440. So let's look at what would our journal entry be here. So we'd have, let's just say equipment instead of delivery truck, because that's what Welly Plus is going to call it. And we're going to debit that, that's an asset, $27,440. And then this $180 is going to be some sort of expense. Let's just say maybe license expense. Remember, expenses are also debits because they reduce retained earnings. And then this $2,400 is also, we might actually capitalize that in the short run, prepaid insurance, depending on how we want to treat it. Prepaid insurance would be an asset, $2,400. And then, of course, we're paying cash out for all of that. That's an asset going down, the $30,020. So that's what our journal entry would actually look like. Okay, so that's cost of acquiring long-term assets. Then the next issue is going to be using the asset. So let's start with the idea of depreciation. And we've been recording depreciation. We just haven't really kind of narrowly discussed it and studied it. But really, if you think about it, depreciation is just taking this cost we arrived at over here and allocating it over time. So let's look at an illustration of depreciation. So on January 1, 2014, we have a country club purchased a new riding mower for $15,000. It's expected to have a 10-year life and $1,000 salvage. So let's start with the January 1. what would our journal entry be? So here again, we would have equipment, that's the asset, going up for cost, $15,000. And then cash was given out in exchange, $15,000. So we've got an asset exchange, equipment going up, cash going down. Then at the end of the first year, we would depreciate that. So let's look at how we would actually calculate that. So we're going to take cost and then subtract this $1,000 salvage. Salvage value is what we think we can sell it for at the end of its useful life. So this company expects to use this equipment for 10 years. So at the end of 10 years, we expect to sell it for $1,000. And again, we're really guessing, aren't we? I mean, who knows what we can sell it for 10 years from now? It's really quite a guess. So again, we're just taking cost minus salvage value, what we think we can sell it for at the end of 10 years, and divide it over its useful life. And notice it's not how long I think the asset can actually exist, it's how long we intend to use the asset, its useful life. Okay, so 14,000 divided by 10 years, we're going to get, whoops, not 14,000, we're going to get $1,400. Sorry, I have a little dog that likes to yap a lot. $1,400 is going to be the annual depreciation. Okay, so depreciation expense, right? Expenses reduce retained earnings. This accumulated depreciation is a contra asset, right? It's a negative asset. And negative assets cause assets to go down. Okay, so that would be at the end of the first year, 2014, assuming that was our year end. That's the year that we're accounting for. And let's go to the next page. Then the next year, right, the second year, we would have the same journal entry. Debit depreciation expense, right? Expenses cause retained earnings to go down. Accumulated depreciation causes assets to go down. So let's go back to our journal entries over here. So we only made one journal entry to equipment. That's its cost. So nothing happens to cost over the 2 years, right? The original cost was $15,000, and that hasn't changed. So each year end, what I want to make is we report the original or historical cost. The original or historical cost, whichever you want to call it. Then at the end of the first year, recall, we only put $1,400, right, in this accumulated depreciation. So we had $15,000 and then $1,400. So I have $1,400 in accumulated depreciation. So on the balance sheet, remember, we had the original cost minus accumulated depreciation, and we net that to book value. In this case, it's going to be $13,600. And book means accounting, the accounting value. Remember, years and years ago, the accounting records were physical books. And that's why this phrase, book value, is where it comes from. So the accounting books or the accounting records. So book value means the accounting value, or the value in the accounting system. All right, then, right, we credited accumulated depreciation again for another $1,400. So now it has grown to $2,800. The amount accumulated, it went from $1,400, we accumulated another $1,400 to $2,800. So the book value has gone down to $12,200. Now, each year we ask for depreciation expense. Remember, expenses get closed each year end. So closed each year end. So because we close that at the end of 2014, it'll start with a zero balance in 2015. So when we debit depreciation expense again, it's a new balance. So the annual depreciation expense does not grow. It's going to stay at $1,400, but the amount accumulated on the balance sheet grows. Okay, now, another thing that's really common with depreciation is that a company will change its estimate. And think about it, that makes sense. Remember, they estimated salvage value to be $1,000, and they also guessed or estimated that they would use this asset for 10 years. Well, what if in year 3 the company changes its estimated life from 10 to 8 years? So what will happen when we do that is we're not going to go back and change any of these old numbers from prior years. We just go forward with it. So when I have a change like this, a change in estimate, I'm just going to move forward with it. I'm not going to go back and change any old numbers. I'll just move forward. So what I mean by that is then I'm going to take the book value. So I'm going to take the book value, right, and that represents what has not been depreciated, right? Book value is costs less what's been depreciated. So this $12,200 is what we haven't depreciated at the end of the second year. And I'm going to subtract salvage. And if I had a new salvage value, I would use the new salvage value. And then I'm going to divide by the remaining useful life. So how many years remain in our new estimate? So let's go with this. So in the year of change, here's the third year. At the beginning of the third year, right, last year's ending is, right, the third year's beginning. So book value is $12,200. We're not changing salvage value, so it's going to stay at $1,000. So $12,200 minus $1,000. And then our useful life, well, we're changing it to 8 years. We've already depreciated 2, so there are 6 years remaining. So instead of, right, originally there would have been 8 years remaining, now there's only 6. All right, so 11,200 divided by 6 years is 1,867. Okay, so at the end of the third year, here's our annual depreciation expense entry, right? Oh, I did that wrong, sorry. Debit depreciation expense, it does not increase retained earnings. It decreases retained earnings. And accumulated depreciation reduces assets. Now, instead of $1,400, the dollar amount of this journal entry for year 3, year 4, year 5, year 6, and year 7, and year 8. All the subsequent years, this will be the dollar amount of that journal entry. Okay, so let's go up. Here's our depreciation expense. Expenses go on the income statement. Okay, and then we have, right, accumulated depreciation is a contra asset. So when I credit it, it does cause assets to go down, but the account itself goes up. It's contra a negative asset. So if it goes up, it causes total assets to go down. Okay, so 1867. So I had 2,800 in there, plus 1867 will give me a balance of 4,667. And we didn't do anything to the equipment account. It stayed at 15 grand. Okay, so 15,000 minus 4,667, the book value at the end of the third year, 10,333. Okay, so we have looked at how to assign original cost, what's the journal, how to calculate straight line depreciation, how to record depreciation expense at the end of each accounting period, what it looks like, here's the balance sheet, what gets reported on the income statement, and then lastly, what we have looked at already so far today is what if we change an estimate, like salvage value or useful life. So let's move on. If we were actually in class, I'd probably have you work together and apply what we just had gone over, but I'm not going to do that, and I don't want to do it for you. This is also in your Wiley Plus assignment, and they'll give you a chance to solve for revising annual depreciation for a change in an estimate. Let's go to our next topic then, expenditures after acquisition. So let's go back to our first page. So we've looked at, right, when we originally buy it, what's the debit to the asset account? How much are we debiting it? Then over its useful life, how do we depreciate it? And what if we change our mind, change our estimate? And so now I want to look at expenditures when we spend money on these assets. And we will. Think about your automobile. You have insurance, you have taxes for your car tags, you change the oil. If your car gets really old, you may even have the engine, I'm not going to think of the word now, but changed up, so to speak. So the big question here is whether when we spend money on it, do I capitalize it as an asset or expense it? And we've actually looked at this idea of cost. So we know that costs can either be assets or expenses, right? Costs, usually we're crediting cash or some sort of payable, right? We either charge it and the liability goes up, or cash, the asset goes down. So we're either crediting cash to cause the asset to go down or crediting some sort of payable, accounts payable, notes payable, loans payable, and liabilities go up with credits. The question is, what is the debit? So the accounting theory is that we debit assets if it has a future benefit to the company that we haven't consumed yet, and we debit expenses if the benefit's already been consumed or will shortly be consumed. We've already used it up. It's an expense. Okay, so let's go. We're actually going to apply this concept. When we pay for repairs and maintenance, does it have a long-term benefit or not? Do I capitalize it as an asset or expense it? Okay, so here we have that the company had the following two transactions, paid $44 for an oil change. Well, an oil change lasts you, a few weeks? So that has short-term benefit. So we probably would, for number one, expense that. So maintenance and repairs expense. Again, it only has short-term benefit, not long-term benefit. $44, right? Expenses cause retained earnings to go down. And then the credit is to cash. Assets go down with credits. Number two, paid to install special shelving units that increases the operating efficiency of the truck. So that's going to have some long-term benefit. So in that case, I want to capitalize that because it has long-term benefit. And when I say capitalize, I mean the debit is going to go to an asset account. Okay, so let's debit equipment. And paid cash, so credit cash. So we kind of have an asset exchange. Let's see, 519. Okay, we're really cruising along. So again, when you have an activity in Wiley Plus, the main question is, does it have short-term benefit or long-term benefit? Whether the debit is to an expense or an asset account. Okay. Going back to our first page, so we've looked at when we buy it, when we use it, allocate depreciation, when we spend money on the asset. We'll get to this another time. Let's look at disposals. So eventually, we're going to want to dispose of the asset. So let's go look at an illustration. And this will be our last topic for today. So O'Brien purchased a copy machine on January 1, $5,000, delivery fee of $200. Plans on using the machine for 4 years, at which time it estimates a $1,200 salvage value. On June 30th, they sold the copy machine for $1,400. Make appropriate journal entries. Well, we need to go back and figure out on January 1, what was that journal entry? So we would have, right, debited equipment, right? But what's the cost? Oops, sorry about that. What was the cost of that? Well, $5,000 plus a delivery fee, so $5,200, and cash, assuming cash was paid, cash went out $5,200. So at that time, right, we debited equipment $5,200. Then each year end, 12/31/17, we had to depreciate this asset. So we would have taken cost, $5,200. We would have subtracted the estimated salvage value, $1,200. Right, so we have $4,000 we want to depreciate over 4 years. And so we would have made a journal entry, debit depreciation expense, $1,000, and credit the accumulated depreciation. I'm just going to abbreviate depreciation, DEP, $1,000. Okay, so here's 1/1/17, and then 12/31/17, we would have made this journal entry, right? Accumulated depreciation is a contra asset, so it goes up with credits, $1,000. Then 12/31/18, right? We would have made the same journal entry, debit depreciation expense, credit accumulated depreciation, another $1,000. And then 12/31/19, we would have done the same thing, right? So at the beginning, or at the very end of 2019, we would have had a balance, 12/31/19, there would have been a balance at December 31st, 2019, a balance of $3,000. Okay, now we go into 2020. And in the middle of the year, right, 6 months have gone by. 6 months have gone by, they're going to sell the machine for $1,400. Well, first off, they've used this machine or equipment for 6 months. So we need to record depreciation expense for 6 months. So our standard entry for depreciation is debit depreciation expense, credit accumulated depreciation, only this time it's only for 6 months. So I'm going to update accumulated depreciation. So 6 months have gone by. I want to record half a year's depreciation. That would be $500, right? If the annual amount is $1,000, then half a year would be $500. Okay, so move some of this down a little bit so you can see. Okay, so let's post the 500. And it's going to be 6/30/2020. So now we have a balance of $3,500. So June 30th, 2020, the balance is $3,500. Okay, now they sell it for $1,400. So I update depreciation. So I update depreciation, and now I need to record the sale. So the sale, cash will come in, So I debit cash, causing, right, cash to go up. Now, when this is all over, once we sell this equipment should have a zero balance, right? It should be zero, and then accumulated depreciation should have a zero balance, because this is the depreciation for this equipment. So I want to zero out these accounts. So I decrease accumulated depreciation with a debit. So I'm going to debit accumulated depreciation. Right? That will cause it to go down. For its balance, $3,500. And then to reduce it, I will credit equipment to cause it to go down. For its balance of $5,200. Now, net those together. $5,200 minus $3,500 is a net difference of $1,700. That's its book value. It's accounting book value, right? $5,200 minus $3,500 cost. It's the $5,200 minus the $3,500 is a net book value of $1,700. Okay, so we have the asset with an accounting value of $1,700. That doesn't mean that's what it's worth. That's just what we have in the accounting records for it. So the accounting records have a number or a value of $1,700 that we sold for $1,400. We lost on the situation, right? So we actually have a $300 loss. Losses are like expenses. So loss on disposal of plant assets. So we have a new thing, losses. Losses are like expenses. They reduce retained earnings. If I add up my debits, these debits total $5,200, and I have the one credit that also totals $5,200. So I will have a loss. And a loss goes on the income statement. Losses get reported on the income statement. Okay, now let's look at an alternative. Instead of selling it for $1,400, what would this all look like if we sold it for $2,000? Well, we'd have the same situation, right? It's just the sales price at the middle of the fourth year that changes. So, let me move this up a little. Okay, so we'd still have the debit to equipment, credit cash. We'd still have this balance of $5,200. And each year end, we would have made this $1,000 entry to depreciation expense and accumulated depreciation. And then also, we would have half a year, right, in 2020 of $500. So all of that stays the same. So we'd still, right, have to update depreciation. Oh, let me use black. So we would debit depreciation expense and credit accumulated depreciation. So I'd have the exact same entry I had before for $500. Debit depreciation expense and credit accumulated. I'm just going to abbreviate it. I'm getting tired. So credit accumulated depreciation. And again, that's just updating the depreciation for 6 months. So I'd have the same entry here. So I'd have the exact same balance as $5,200, $3,500. The only difference this time is that the cash we get is not going to be the $1,400. It's not going to be $1,400. It'll be $2,000. But we still want to get rid of cost and the $5,200 and this $3,500. So I want to debit accumulated depreciation to zero it out. So I debit that. That'll cause that, right? And when I post that debit, right, that'll cause this account to zero out. And I want to reduce equipment for its balance of $5,200. And again, if I post that $5,200 credit, that'll give me a zero balance there. Okay, so I still have the $1,700 book value, BV. I'm just abbreviating it BV for book value, $1,700. $1,700 book value. Okay, if the accounting records have a value of $1,700, but we were able to sell it for $2,000, we actually have a gain on the transaction. Gains are like revenues, so we credit them. So gain on disposal of plant asset is what Wiley Plus will call that. And that causes retained earnings to go up. It's like revenue. So, or it's similar to revenue. Okay, and that will go on the income statement. Okay, that's enough topics, I think, for one setting. And we'll stop here. This will enable you to do the first part of your Chapter 9 Wiley Plus assignment as listed in your assignment sheet.